So last week, yes, we were discussing this one, NPV, right? We did NPV, then this is the cash flow we use, right? Okay, you have a initial investment, then yearly you have cash flows R1, R2, R3, like that. So our aim is to find the difference between initial investment and the present value of all future expected cash flows. So you bring R1 present value, R2, R3, like that. You bring, this is the equation. Total present value would be adding up all the present values, right? Net present value equals present value minus initial investment, since initial investment is a cash outflow, right? So this is the equation we discussed. Future value equals present value into 1 plus I to the power n, which work out to this, right? Present value equals future value divided by 1 plus I to the power n. So we can take this, we can rewrite the formula like this. Then 1 divided by 1 plus I to the power n, this is known as the discounting factor, right? Like this. So you have to work out. Normally, if they ask you a question, they will give the discounting factor. If not, only you have to create your own discounting factor. They will give the cash flows, they will give the discounting factors, right? So you have to calculate the NPV. So then we went to discuss the advantages and disadvantages of net present value. Today we will go to IRR, internal rate of return, right? Let me show you. This is IRR, right? So IRR is the interest rate or discounting rate at which net present value equals 0. IRR is the discounting rate at which NPV, net present value, equals 0, right? If you plot the discounting rates and the NPVs of a project, right, this is how it will move, right, towards 0 side. That's the smaller the discounting rate, higher the NPV. When you go towards higher side of discounting rate, NPV will come down. So this point, this one. Right, this one, this is the point. This is where NPV equal to 0, right? NPV will move on this curve, and this is NPV equal to 0. That is the discounting rate we call as IRR, right? This is the formula. You add up all things, right? NPV has to be 0. On Excel, you have the IRR formula. So you can have the initial investment like this. Then you have your R1, R2, R3 like this one. How you calculate on Excel is, you go to this place, any cell, go to function, check IRR, Go. It will bring you IRR. Select that and say OK. Right? Then the values will be, you select the entire value. Okay. Then you have to give a discounting rate. If leave zero blank, it will take 10%. So you can take the weighted average cost of capital like this. Then it will give you IRR like this, 57%. Right? This is IRR calculation using Excel. Right? Whereas in your day-to-day life you can, right? So this is how you can calculate IRR on your day-to-day functioning, right? But you need to know the how to do it manually as well. That is how the course operates, right? So let's go to the presentation. This is how we calculate IRR manually. In order to do this manually, you need to find two NPVs and two discounting rates. This is the formula. Right? This is the formula we use. You need to find a discounting rate. Like when you have the cash flows, what you do, you take a discounting rate. It is a guesswork. So you just take whatever the discounting rate you prefer, right? But you need to find two discounting rates at which NPV is near zero but positive. That is I1 discount. First discounting rate, you insert a discounting rate and do the calculation to find NPV. There you need to get a negative or positive value. I need a one discounting rate where NPV is positive, right? Then I need another discounting rate where NPV is negative. Negative discounting rate is I2, positive interest rate, positive NPV discounting rate is I1, right? So when you are doing that calculation, you have to remember this. You guess a interest rate. If when you put the interest rate, if you get a positive interest, positive NPV, that means in order to get a negative NPV, you need to give a larger discounting rate. That means 30 or 40 you need to give, right? If you give a interest rate and if the NPV is negative, right, we say it is, you have given 30, then it is negative. That means you are in this side. That means positive, you have to give a smaller interest rate. So minimum of 3 times you have to work this, because you give an interest rate, you assume an interest rate and apply, then you will get either negative or positive NPV. If it is positive, that means you need your negative NPV, you need to increase the discounting rate. When your initial interest rate, if you get a negative, that means for the second time, you need to put a smaller interest rate, because positive means you are here. You need to find somewhere here also. That is positive, negative. If the initial one came here, you have to give a smaller one. Like that, you need to do at least 2 or 3 times NPV. Right? Why? We want to find this formula. Right? So I1 is the discounting rate at which NPV is near zero but positive. Then you apply another thing, it is I2, discounting rate where NPV is zero but negative. right? This PV indicates I1's NPV, right? Where in positive NPV, PV is positive value, right? Then NV is negative value. The NPV, net present value, which we got with I1, I2, sorry, I2. But you take only the value, not the negative sign. We say it is negative 30,000. You take only 30,000, right? So this is the formula you are going to need in order to find IRR, right? Now let's go to the presentation. Okay. Right. This is your cash flows. I want you to forget about NPV, but I need you to calculate this NPV and let me know whether you got this 965. Your interest rate is 20. This is the discounting rate. You just do one, right? And let me know once you finish. My chat box is open. You can let me text me and say you are finished. I have how many people? I have 20 people. So I want everyone to do it and let me know. Right? I'm waiting till everyone is finished. You can see my screen. This is your cash flow. This is your cash flow. Initial investment is 100,000. First year cash out, cash in. These are the cash flows. These are the discounting rates. So find out NPV and you should get this figure. Once you finish, let me say you got it. Oh, done. If you have an issue of finding, let me know. I'm watching the chat box now.
Excuse me, sir.
Yes.
Sir, we have to find that NPV by applying to that equation PV equals FE over 1 plus Rn.
Yeah,
Is
no,
that
1 plus 1 divided by 1 plus I to the power n is given here. That is the discounting factor.
using that by applying to the equation, we have to find that answer.
Yes,
The
yes,
9,006. Okay.
yes. So, where is it? This factor is given.
Okay.
You don't need to recalculate that.
Okay.
Right?
So I don't understand this cash flow.
Yeah.
If we take year one, 45,000 into discount factor is 0.833, right?
Yeah. So you get 37,500. I have given the answer also. I just
Yeah,
don't.
37,485. I
Yeah,
thought
that
of.
is a multi. It is a upward, rounded upward one.
Ah,
Right.
okay.
Right.
Right, right. Okay, okay.
Right. This rounded upward thing is because I have curtailed it for 3 decimal points. When you apply the formula, it is more than this, right? More than this decimal. So when you use the actual figures on Excel, you get these figures, right? So if your answer comes nearby this, it's fine. Yeah, that's fine. Because you are working only with these 3 decimal points. I have taken it from the Excel, so it is for the entire thing. Chance it is 961 or you have a zeros. Okay, right, thanks. 13 people has completed, few more to go. Okay, what about others? $15. Right. Now do the same thing for 16 for this one. Now what happened? I applied I equal 20. You got a positive NPV, right? That means you are here. Now you want to find a negative NPV. That means you have to have a higher interest rate. If it is a lower interest, NPV will move towards this side. You want a negative one. So you have to move the discounting rate to higher side, right? So this is your cash flow. Your initial was 20. Now we are going for 30 because you need a higher rate. These are the cash flows you have. Please work out and see whether you are coming nearby this. Right? And let me know. Okay. 6 people has completed. Eleven completed. Chagita, it is minus or positive, negative. Okay, 10. D15 has completed now. Now, with these figures, work on the IRR. I1 is 20. You can use this figure 69645 as the positive value. Then I2 is 30 and your negative value is 8279. Right? 30 and 827. So we know I1 is 20 plus I2 minus I1, 30 minus 20 divided by positive value plus figure of the negative value, right? Not minus, without minus sign, right? Divide this two and multiply by positive value. See what is the answer you are getting?
So that means we don't consider the minus value as 98290, is it?
No, no. You take only the what was the figure?
So that means 8290 plus 9610, is it?
You got yeah. So it has to be 9610 plus 8290,
Ah,
right?
okay.
You are not considering the minus figure here. Only the value we are taking, absolute value.
Okay, sir. Okay.
Ramadan, thank you. 7 people has finished.
So sorry, sir. I don't get this answer. I don't know whether I'm wrong.
What is the figures you got? I1 is 20, right?
I1 is 20, I2 is 30. That means point 3 and point, sorry, point 2 and point 3.
Yeah, so you 30 minus 20 divided by positive value, which was
17,900.
uh, 9610,
Yeah.
right? Plus
829.
8290.
Okay.
That figure has to be multiplied by positive value 9610.
Okay.
You will get.
Into point 2, right?
Why?
In
Yeah, you have
plus
already
point 2.
done that. See, this is point 30, no? Point 3 minus point 2 is
Point 1.
point 1 divided by the two values
7.
of this, then
Okay.
into 9610. You can get,
Point 2. Okay, sir. Right, right. I
right?
have multiplied by point 2.
Okay, okay, that's the interest rate.
Yeah.
Okay.
Okay, sir. Thank you.
Anyone else has a problem? Only 7 people has completed it. The only you have to multiply zero point 0.2 plus zero point 0.3 minus zero point 2, zero point 1 divided by positive value, which is 96 or something, plus the negative value of the negative, which is 88290. That portion has to be multiplied by positive value 96110. Right? Try it again. So it is going to 0.2, which is 20% plus 0.3 minus 0.2 divided by the values of both the figures, 9610 plus 8000 or something, right? Multiplied by 9610. Hurry up, we'll have only another 5 minutes for this. After that, we need to start. It comes this way. So now I have 1, 2, 3, 4, 5, 6, 7, 8. 8 people completed, only 50%. Right. So whoever could not finish, please do it and see whether you are getting this. Right. So that's okay. So you are getting something like this. 25 all got similar thing. So similarly, you can do the same thing for project B. Then IRR is 22. Project A IRR was 25 and project B IRR was 22. Right? So whenever you are evaluating two projects, we are taking the project which gives you a higher IRR. That means higher rate of growth. IRR indicates the possible rate of growth. So higher the IRR, better the project, right? Which project is better. So advantages and disadvantages of IRR. Advantages are it considers the time value of money. Then we take cash flows over the entire project life. Whereas disadvantages, it is very difficult to calculate, but it gives incorrect decision when the project lives are. You can't compare two different projects, completely different projects with it. That means one project life is 5 years, another one is 10 years. You can't compare. It has to be apple versus apple, right? You can't compare apple and a pear. So it has to be similar projects, right? So that comes to the end of, like, this is a summary. From all three methods we calculated, we got project A as the best project, right? Then that ends the investment appraisal methods. Then we have project risk, right? So when you're talking about risk, you have credit risk, whether we will get our money back. Then we have market risk. Will we be able to get the market, right? Operation risks are any risk relating to the operations of a project. It can be a delay, it can be a fraud, it can be a mismanagement, like that. Then reputation risk, that is the reputation, right? Yes, it may be very profitable, but if you have a bad reputation, bank will never come and put money in, right? This is looking at the project angle. Then the liquidity, the ability to get cash. Because yes, everything is fine, but your cash flows are very tight. Then it is liquidity risk. Then the legal risk. Is there any illegal thing happening? Or can there be legal changes in the country which will affect this project? Like that, we have different risks when we are looking at a project, right? So you have to look at all, even technology risk, whether technology is changing very fast, right? Like that, we have different risks associated with any project. So we have to look at all those things when we are deciding on a project finance, right? Then these two are finished. This is finished. Right. Now we'll go to this lecture 9, number 9. Right? Here we are talking about 6 C's of credit. Right? This is how we look at a business. This is how we look at a person. Whenever a banker wants to finance someone, it can be an individual, it can be a business. We need 6 C's to be checked. What are 6 C's? What is the meaning of that? Will the borrower pay? Our intent is to find out, will the borrower pay? can the borrower pay? Right? Does the borrower have enough cash investors? Like, what is the commitment this borrower has towards the business? If something adverse happens, what will happen to this business? Like tourism industry. What has happened now? In case of a bad event happen, if the customer does not pay, do we have any protection? Then will this borrower has enough cash to run the business? Because you can have machinery, you can have factories, everything, but if you don't have cash, day-to-day run cash flow or the working capital, you can't run a business. Right? First one, it is the character. Out of 6 C's, the first one is the character. It is the character of the company. It is the character of the persons behind that. Right? So we have 2 characters. It's the financial character and the normal character. What we all know. Financial character is okay. It is their repayment history. They are dealing with other financial institutions. If they have defaulted another financial institution, they will default us as well. If they have a bad history, previously they have not paid, very ad hoc payment. So now they are okay, but they can repeat it. Right? If a customer, we can't say customer is very good, but their credit is bad. Right? It can be, yes, we have seen very good customers because of some incidents with banks. They are very arrogant and they are not paying that bank, but they are paying all other banks. But the same thing can happen to us. So you have to be vigilant about those kind of things. So always you need to have the trips. These days is very difficult, but if you have a reasonable, okay, I went to areas because I couldn't pay, then I got it rescheduled and now I am paying. Then it is a little positive that no, I will pay when I can. Right? Like that. So when you are looking at the character, it is the financial character we are considering most. But you need to consider other things. Who are the directors? With whom are they dealing with? Are they punctual? Are they treating their staff well? All those things comprises the character, right? Financial character is only one part. But if you have to look at other angles as well, otherwise what will happen? If my customer is dealing with all the bad people in the market, right? So that influence may come in because we are giving money for long term, right? Once something goes wrong, we can't take our money faster, right? So character is the most important C or the point to look at when you are lending even to a person or to a business. Then capacity. This is the ability to pay, right? How much can he pay? For individual, we take 60% of his take-home salary for repayment, right? For businesses, if it is a long-term loan, we calculate debt service cover ratio. If it is a short-term loan, capital is, any business is financed by 2 methods. Your capital. You have owner's funds and the long-term borrowings from banks and financial institutions. Owner's funds, we say it is the equity capital, whereas long-term funding from banks, it is debt capital. Right? So whenever the borrowings from a bank is higher than the equity investment, whatever you earn, major part has to be given to the bank. So it is risky because people are not doing business to increase the wealth of a bank. Right? Therefore, there has to be a balance. So normally we calculate gearing ratio, debt equity ratio when we are looking at capital, how much they have invested. We take debt equity, 60% debt, 40% equity. That is the maximum level we should finance. There is no hard and fast rule, but normally we stick to 60-40 debt equity ratios. Right? It is better if you can have 50% debt, 50% equity, but you can go to 60-40. When you are looking at a startup stage business where initial cash flows are very small, you need to get equity the maximum, smaller the debt. Why? Because when you give a loan, from day one, you need to pay the interest. When cash flows are small, you can't pay that interest, right? For your money, the borrower can stay without a profit. But banks, we need our money and our repayments, whether you make a profit or loss, because we have invested others' money, depositors' money, right? So capital is a very critical item. Then we go to fourth one, condition, right? Condition is not the conditions we put it to a customer when we grant facilities. It is the condition of the industry my customer is in. If someone comes for a hotel today, I may not give money. Why? Tourism industry is not good now. We don't see an end of a tunnel still for tourism industry. Right? If someone comes for imports, I may not consider these days. Why? Dollars are very limited. If someone comes for agriculture or some essential good manufacturing or export, I will give my money because market is very good for them. Right? So whenever customer comes in, you need to see what business he is in, whether that business, that industry is a good one, what is the outlook, what is the current position. Right? Based on that, you decide. Then we go to the fifth C of 6 C's, which is collateral. Right? We are always giving out others' money. It is not our money. So we need to get our money back some way or the other. Therefore, always you need to have a second way out. First way out is cash flow, repayments. But if the customer does not pay due to any reason, it can be willful, it can be reasonable. But still, we need our money back. Why? We have to return the money to the depositors. So therefore, we need to have a collateral normally. We discuss about collateral security. We discuss about reduce imbalance, increase imbalance, stable, fluctuating. Then we discuss ownership transfers, liquidity, valuability, and all those things we discuss. So that is to come to this point, collateral. Right? If your question is what are 5 C's of credit, this is the 5 C's of credit. If you are asked what is 6 C's of credit, 6th C is cash flow. Whether this business has enough cash to run. Right? Does this business has enough liquidity to run? Right? All other things are good, but if you don't have cash, you will get stuck. Right? if the question comes as 5 C's of credit, if someone asks you what is 5 C's, it is character, capital, capacity, condition, and collateral. If someone asks 6 C's, it is cash flow. Sixth one is cash flow. Don't bring cash flow to 5 C's. Right? So that is 6 C's of credit. Right? So we look at this, whether we are financing an individual or a business. Right? Why? Individual also same thing matters. It's character. Right? Then how much he is investing, because to increase the commitment towards repayment. Capacity, that is his ability, his monthly salary, how much is he earning. Only we take 60%, 40% we have to give it to the customer. That is the rule. But you need to have a buffer always. Right? Are we getting a security? What is the fallback situation? Personal loans are clean basis. We don't have a fallback situation if you don't have a guarantor or some sort of a thing. Right? Collateral. Condition is which business he is, which job he is in. Is he a qualified person? If he lose the job, can he find a job? Is he in a good reputed business? Will he get his salary continuously? Like that, that is condition when you look at personal lending. Similarly, when you are looking at business lending through 6 C's of credit, it is debt service cover, gearing, character, condition in the industry, collateral we are getting, and the cash flows. Right? So this can be applied to individual lending as well as business lending. Right? So we end the lecture 9 there. Any questions on that?
So small question. Now see, like let's see real estate business or like අපි හිතමුකෝ අර ගෙවල් හදලා විකුණනවාගේ රියල්
මොනවාද?
ගෙවල් හදන විකුණන රියල් එස්ටේට් වගේ බිස්නස් එකක එතකොට කෑෂ් ෆ්ලෝ එකක් අපි එහෙම ලොකුවට දකින්නේ නැහැ නේද? එතකොට අපි මේ විදිහට එතකොට අපි
බලන්න වෙනවනේ එතනදී. මේ දැන් මේක විකුණ ගන්න බැරි ඒරියා එකක තියෙන ඉඩමක් නම්
ඕකේ
එතන කෑෂ් ෆ්ලෝ එක දෙවිදියකින් බලනවා. එක විදියක් තමයි යාගේ තව බිස්නස් තියෙනවද? තව ඉඩම් කීපයක් කඩලා විකුණනවාද? එතකොට මේ ඉඩම් විකුණුන නැති වුණත් අපිට ඒ ඉඩම් වලින් හරි එන සල්ලි වලින් අපේ ලෝන් එක ගෙවා ගන්න පුළුවන්. හරි. මම තනි එක ඉඩමක් කරන පුද්ගලයෙක් ගත්තොත් cash flow එක වෙන්නේ how liquid is the land.
ඕකේ
ඉක්මනට විකුණ ගන්න පුළුවන් land එකක්ද බැරි land එකක්ද? Very right. Any other questions? Right. If no questions, please ask me. I prefer you asking me questions. ඕනේ භාෂාවෙන් අහන්න දෙමළෙන් අහන්න එපා මම දන්නේ නැහැ. Sorry. Right. We go to lecture 10. We'll try to do as much as possible here. Maybe we have half an hour to go. We are looking at retail and corporate evaluation. Right? We have different models. So major categories are consumer lending, that is for individuals, right? Salary backed. It can be personal loans, which are normally short term to medium term, which are normally clean basis one. Mortgage loans, Normally it is housing loans. If the loan is backed by a mortgage, we call it a mortgage loan. If it is not a mortgage backed one, it is a clean basis personal loans. Then commercial credit is lending to businesses, right? Lending to businesses. Then we have development credit. Development credit comes into microfinance. That's the grassroots level, small scale financing. Then project financing, what we discussed earlier. Projected cash flow based lending. Both are cash flow based lending. Microfinance is grassroots level. Project financing is we lend based on projected cash flows, right? Without recourse to the investors. Right? International trade is exports and imports, which we discussed earlier. Retail and consumer credit evaluation. We just finished 6 C's of credit. We have other models developed through this. One is papers. Purpose. What is the purpose of this loan? The amount, how much are we giving, right? Period for the period. P is for the period. How long? Whether it is 5 years, 6 years, that one. Expertise, that is mainly to look at the character, commitment, capabilities when if it is a customer, SME customer who is earning through business, but he is borrowing personally. Manager skills, and because his earning would be from the business. Repayments, ability to repay. Security, it is the C. So these are different versions of 6 C's end of the day. Right? We call it papers. P for purpose, amount, period, expertise, repayment, and security. Right? This is one model. Then you have parser. Right? Parser is also another version of 6 C's. Person, who is the person? Earlier we look at character. Amount, repayment, again, security, again expediency, which is similar to earlier thing, then remuneration. Profitability to the bank in this case. Profitability to the bank. Why? We are not a charity organization. We need to have profits for a business. If it is not profitable, why should I lend? Right? Then we have Campari. In your past papers, you can see they used to ask Campari or 6 C's alternatively. Right? Campari is one famous model we use. Character, then ability. How you are going to repay? Because whenever a customer comes to you, your question to the customer would be, කොච්චරක් ගෙවන්න පුළුවන්? ඔයාලට ආදායම් එන්නේ කොහෙන්ද? That is ability. Right? You need to find out how much you can pay and what is the sources of income you have. That customer needs to pay, show us, confirm us. Otherwise, that's in story. If customer can't say, this is how I am getting money, if they can't prove that, we don't go beyond that. Here M stands for margin, which is the contribution by the client. That is capacity under 6 C's of credit. Sorry, capital under 6 C's of credit. Then the purpose, then amount, how much we are giving. Purpose, legal, illegal, we don't give it to illegal. Normally we give for consumption purpose and commercial purpose, but not for speculation, right? I'm buying money just to getting a loan to increase something and earn money and deposit. No, we don't do speculation. Purpose, then amount, how much, right? Then repayment. Here we should know the customer's profitability, profit margins, then debt service cover ratios, all those things. Right? There is a slight difference between ability and repayment. Ability, as I told you, how you are going to pay and how much you can pay. Repayment is the profitability of this business and the debt service cover of this business, which they need to pay. Sure. Then comes EI. Campari, I is for insurance or security. Mainly it is insurance. Insurance for the repayment, that is the meaning. So it can be insurance, it can be collateral. Insurance for the repayment, because in our country we don't have a insurance. Right? So insurance for credit risk. Some other countries, they have. Right? Developed countries, they have that. But in Sri Lanka, we don't have a credit insurance. So Campari is character, ability, margin, purpose, amount, repayment and insurance. Right? Then we go to corporate credit evaluation. MIFID. Right, this one, MIFID. So M stand for management, I for industry and market, F for finance, E for environment. Here we are talking about a broader environment. It is legal, political, regulatory, social, economic and technological environment. It is not environment only. It is everything. Then risk and mitigates. When we are looking at a business, we just discussed about the project risk. So similarly, risks and mitigates. Then the terms and conditions. What are the terms and conditions we put forward to a customer? That means today we are evaluating a customer at one level of risk, one environment. We want to maintain the same level of risk into future as well. Why? Because with time, normally risk increases. So we take precautions to maintain the risk levels. That we do through terms and conditions. We will look at what terms and conditions are shortly. Management is like we discussed these things earlier as well through the project evaluation. Why we need management? It is the management ability to face a hard time or worst case scenario. Management ability of formulating, executing a strategy. I spoke to you about experience and qualification. If you just have an experience, your broader vision will be lower. If you have lot of qualification but no experience, your implementation will be at risk and your practicality is at a risk. So it has to be a combination of that. As a banker, we should be able to have direct access to the directors and the key decision makers. If we have to deal all with the account clerks and those people, no, don't go to finance. Because we don't know where the business is going. Management thinking we don't know. We are blindly financing. No, we are not going to do that. Then integrity of the shareholders, directors, and the key management personnel. Right? That we have to know. Then the directors' expertise. Like we have directors, they don't know anything. Just my mother's brother's son is in the director book. So what is the value addition they can give? Right? We will have issues. Ownership structure. Sole proprietor, partner, or limited liability company. Have the directors and the top management handle a difficult situation? Have they faced? Do they have experience that in that kind of a thing? From books we can learn a lot, but when it comes to practicality, we have issues. Same with us. We can learn everything, but if you don't practice, you will not gain anything. Market, that is the most important thing, as I told you last time. Without knowing the market, you can't decide anything. Production capacity, human capacities, technology requirements, machinery requirements, everything depends on your market. What is the structure? Define the market. Then competitive position. Are we in a monopoly market, monopolistic, like that? Which market? Very competitive market. Which market you are in? Who are the people who are handling the market? Marketing and sales. Market share, expected industry growth. Are we financing a dying industry or stagnated industry or growing industry? For that, we need the outlook for the future as well. If applicable, global market. If you are looking at a export industry or even for a cross-border related industry like tourism, global travel restrictions will affect our tourism. Global, like, okay, when you have a recession in a developed country, like we say, we have a recession in Russia. We have a huge exposure to tourism market for Russia. Then we can't expect Russian tourists in this country because they don't have money to spend, to come and spend money here. So recession, all those things, market, you have to look at. Then the financial analysis, we learn extensively on this. We have to look at the business past history because history depicts the future. If history says negative profit for 2 years, suddenly you can't expect a huge profit. You have to break even. Then you have to get into profit. You have to have proper strategy for that. So in order to know all those things, you need to know the ratio analysis, you need to know vertical, horizontal analysis, trend analysis, all those things. Because you evaluate past and you project the future. You need to analyze the P&L, you need to analyze the balance sheet, cash flows. Based on that, you need to have pro forma, balance sheet, P&L, and cash flows, right? When you are evaluating a business. So we learn those things in extensive manner. Then when you are looking at the financial analysis, we need to know the banking facilities this customer has or enjoy. Why? In case of a difficulty, oh, we never want to be the sole banker of a business. Why? That is because if then we will have to honor all customer requirements. Sometimes we should be able to say, sorry, I can't finance, right? I have to say no to a customer. Give me 1 minute. Oh. Oh, wait. Oh, fine. Oh. Oh. Right? We have to know what are the facilities they have. Right? What are the facilities they have? Give me a second, please. 1 second. Sorry about that. Right? So we don't want to finance all the requirements of a customer. We need to say no sometime. Right? Then we split the risk between two banks. So we need to know the banking facilities. These are the ratios we learned: liquid ratios, leverage ratios, profitability ratios. Then these are the ratios we learned. So I'm not going to take you through all these. We learn these things. Then projections, pro forma projection of borrower's condition, how much finance is required, when the loan will be repaid, ability to repay, use of the loans. Determine critical and non-critical assumptions, use industry projections. This is how we do projections. We need these statements to be projected. Then we come to environment. After finance, we come to environment under MIFID. Right? You have political factors, political environment. Economical factors, it is economical environment. Social factors, technical or technological, legal and environment. We call it PESTLE, right? Under environment, it is PESTLE, right? So, I have separate, but I will take you through this. Political factors, right? Very good example was our port city. What happened 2010, 2015, when the previous regime lost, we stopped. We were saying all those things and we stopped the port city. What happened? We had to give compensation to China, right? If the business is affected due to political situation, that is a political risk. Then economical factors, like I said, recession, dollar pricing, all those things come with economy, buying power, purchasing power of a segment, right? I'm doing tourism. I'm mainly focusing on German market. If the purchasing power of Germans comes down, it affects us as well. Our tea went to Iraq, Iran. Now what happened? Because of the political fight between US and Iran, we can't send tea to Iran. Right? Iraq, one time it was our main market. But Today their currency has come down drastically. So our market is to very low quality tea to Iraq now because of the pricing. Social factors. When you are doing like, when you are, we want to grow our dairy farming in this country. We have a very big issue to solve. When the cows get old, what can we do? We can't kill. In our country, we can't kill animals like that. Yes, we do kill, but in society, it is almost prohibiting now. Right? Social factors relating to the business. How will the social factors affect? Right? I can remember maybe 10 years ago, there was a credit line came for inland fisheries. That means අපේ වැව්වල පොකුණුවල මාළු ඇති කරලා then we were to harvest them and give it as the protein source for the society. Then religious segments, they said, no, we should not eat. Even they were allowed for residents to have our own small pond, gave money, you have your own pond to have your own fish. So we had to stop it because of the religious pressure we came across. Then that trade line shifted only for the ponds development, large scale pond development, not for individual ponds. Like those are social. Then technical factors, technology. With the changing technology, we need to change. Where is Kodak today? Kodak was the best film reel manufacturers in the world. Today you don't have film reels, so no Kodak. They didn't shift to the digital camera. Legal factors, again legal requirements. Countries' land law is a legal thing. Then now BOI Act has changed, then it is a legal thing. Then the environment. It is the environment, how the waste is treated, what is the impact to the environment, which we discussed earlier. So under environment, MIFID, environment, we have all these things. We call it PESLI. We will have little bit more details when I come to PESLI environment. Risk assessment and mitigation. This is what we discussed earlier today. Credit risk, management risk, industry, structural risk is the gearing and all those things, and how the industry is structured. Other risk applicable as per the industry. Then we have terms and conditions, loan covenants and conditions. We have two types of conditions, positive or affirmative or negative. Positive covenants are covenants we put when we are giving a loan, which the customer can adhere, which will not restrict the customer from any. Like covenants, like you need to submit annual audited reports, or you need to submit stock statements, debtor statements, right? All those things are positive, affirmative. It does not restrict your business. It is a monitoring tool. It is a maintenance tool only. But you have negative covenants. Any conditions or covenant we put forward which will restrict the customer from doing so something. Those are negative covenants. Like you can't borrow without getting permission from the bank. You can't pay more than this much to your directors, right? Those type of limiting covenants, right, are said negative. This is some example. Negative capital outlay. You can't invest more than this. You can't pay out dividends more than 60%. Salary not more than this. You can't give security to other place without asking us. Like that, you restrict the business. Whereas affirmative, you ask them to adhere to. It is not a restriction. Current ratio above some certain thing. Certified financial statement. Right? Get a life insurance. All those things are affirmative or positive. They can easily do and adhere. We are not going to restrict. Why we put terms and conditions? That is to maintain the risk level. Right? Then security, we discussed security earlier as well. Then it is easy to value. Easy to value, valuable, easy to change and realizable. Then we have all these increase in value, decrease in value, stable and fluctuating value. Always you need to link the nature of security and the nature of the risk. Right? That means if it is a long-term loan, normally we need hard collateral. If it is a short-term loan, you can go with a mix of hard collateral, fluctuating value, decreasing value, all those things you can. Always we need to have security more than the loan you are going to give. Right? You have to have a buffer to discount collateral. Non-financial tools, we have to discuss what? Pesley and the Porter's FIFOs. We will stop here because these are little lengthy. I can't finish within 3-4 minutes. So we will start with this next week. So out of 15 lectures, we have covered 9.8 lectures now. I have another 20% of the lecture today. So we should be able to finish by September end, first week of October. Right? As planned, we can finish. Then we will have some revision classes before the exam. Right? Okay, thank you very much for today. If you have any question, I can answer you.